Hi, this is Doug Goldstein with the Goldstein on Gelt Show. Wouldn't it be nice to get money all the time, regardless of whether your stocks go up or down? Well, actually, people who buy dividend-paying stocks get to do that. Today, I'm going to be talking to Ben Reynolds. This interview is really interesting because a lot of times people don't even understand what the basics are of dividends, and Ben is an expert in the whole dividend world. In fact, he started a company called Sure Dividend. He's a big fan of something called the Dividend Aristocrats. There are so many different ways of getting cash flow from your portfolio, whether it's interest or dividends, or you just sell things when you need the money. But Ben is a big fan of dividends. And another area that a lot of people don't understand with dividends is sometimes they say, how is it that a company doesn't earn as much money as it pays out in dividends? Where does that money come from? Well, that's one of the questions that I asked Ben on today's interview. I think if you are looking for a total return portfolio, total return means you're not only looking to buy a stock and then it goes up in value, but you understand that the income from your portfolio, meaning how much in dividends you get, is another way of making money other than just capital gains. If you understand that, you're going to want to hear this interview to learn how you can improve your dividend investing. That's my interview here today with Ben Reynolds on the Goldstein on Gelt Show. Okay, I'm very excited to be talking with Ben Reynolds, who is the founder of Sure Dividend, which is an investment site that focuses on high-quality dividend growth stocks for the long term. Now, Ben, before we go into the strategy and everything, let's start with some real basics. What is a dividend?
Absolutely. A dividend is a cash payment from a stock you own that typically comes out of the earnings of the company. So, as an example, if Coca-Cola makes $5 in earnings per share, they might pay out $3 per share as a dividend.
Okay, so now let's talk about the very critical question, which is what happens when you see companies that pay a dividend, but you look at their earnings and the earnings don't seem to be enough to pay that dividend? How are they doing that?
Well, that's a big warning sign, first of all, but they have to fund that dividend from elsewhere. So they might have cash on hand from previous years they're paying the dividend from, or they might be borrowing money. But in either case, it's a warning sign that the dividend is not sustainable and they can't keep paying it indefinitely.
So there are some industries which seem to do this for a long time. You know, a lot of people used to like the oil pipelines, for example. And let me just note, I'm not giving any recommendation. I just really want to talk about the fundamentals of what a dividend is. And they say, well, you know, these pipelines, for example, they just keep paying the dividend and it looks so high. What should they be worried about?
Okay, that's a good point. And that's with MLPs and REITs, which are real estate investment trusts. That's a separate case from the traditional common stock. So with REITs and MLPs, their operating structure is different. So their earnings are very understated relative to the amount of cash they make. So you wouldn't want to look at just an earnings payout ratio with them because they're making a lot more cash their earnings show. So this would be a special case where if MLP has a payout ratio of 120%, the distribution there is likely safe. I mean, depending on other factors.
Let's discuss this a little more. I think this is a very interesting point you're making, and I think people really need to understand the difference. Let's talk for a minute about a REIT, because I think it's something you can really sink your teeth into because it's a real property. Let's say a REIT, which stands for Real Estate Investment Trust, buys a bunch of buildings, and those buildings generate some income in the form of rent that they pass through to the shareholders. How can they pass through more income than they actually receive in rent?
When you're talking about income, income is an accounting measure. So it takes out depreciation, and depreciation isn't a real cash expense. So for example, if, like you said, a REIT owns 5 office buildings, the money they're getting in rent, they can pay out most of that money as a dividend. Their earnings will be understated because the earnings have depreciation subtracted out. And depreciation is just what you would expect the building value to go down every year, but it's not a cash expense. It's not an actual cash outlay, I should say. So that's the distinction there.
That's a great explanation because they actually are collecting the rent. They're not printing money out of thin air. It's not like they're the US government that just can print more money whenever they need it.
Yes, that's very true.
So when people are looking for dividends and they like the idea, they're going to look for a company that either has earnings, like you said, to justify, or maybe it's one of these special cases like a REIT or an MLP, which stands for master limited partnership, which is often just another format that a company is set up in. What are other things that people should look for if they like the idea of getting dividends?
Some other things people should look for are a long history of dividends. Just intuitively, a company that's been paying dividends for 10, 20, 30, 40 years in a row is more likely to continue paying them than a company that's only paid them for 1 or 2 years in a row. So that'll show some consistency there that the business is likely going to persist in the future. Another thing to look for would just be the dividend yield. All things being equal, which they never are, a higher yield is better. You're getting paid more money for every dollar you invest.
I like your comment. All things being equal, which they never are, which is so true. We're talking with Ben Reynolds, who is the founder of a site called Sure Dividend. He's been talking to us about some very important basic issues. What is a dividend and how do companies actually pay the dividend? And Ben also pointed out something which I think is critical, which is to understand that sometimes you'll see types of companies like real estate companies or companies involved in oil and gas pipelines, which seem to be paying dividends, even though it appears they're not making enough money. Before we continue on the dividend track, just tell me, why would someone ever buy a stock if it doesn't pay a dividend?
The reason to buy that would be for capital appreciation. A great example would be Google. If you expect Google to make much more money 10 years from now than they do today, you might want to invest in Google. The advantage to investing in stocks that pay dividends is that they've proven that they're making real money and they're paying it out to shareholders. So you're getting a real return now. You're not sort of gambling on that capital appreciation. You don't require the company to grow to make money.
And how often do companies drop or lower their dividend, in which case I would presume that that's also bad for the stock price?
Yes, it certainly is bad for the stock price. And unsurprisingly, stocks that cut or eliminate their dividend tend to underperform stocks that don't. As far as how often that occurs, it is really case specific. The higher the payout ratio, again, in general, the more likely a company is to cut its dividend. The shorter its dividend history, the more likely a dividend cut is to occur, because management hasn't kind of built up that inertia that they really don't want to cut the dividend. So those are two factors that would increase it. And then a third factor would just be the general economy. There were a lot more dividend cuts in 2008 and 2009 than there were in 2016.
Mm-hmm. So there's definitely a possibility that there could be a conflict of interest, because maybe the shareholders want to get dividends on the one hand, although I guess they would also have a similar interest in growing the business because everyone wants the price of a stock to go up over time. What are some of the problems that people have to worry about when they're investing and focusing on dividend growth?
Some of the problems that people need to look for when focusing on dividend growth are, will the dividend growth continue? And you have to look at that on a case-specific basis. What's causing that company to grow? Will those trends continue? Going back to Coca-Cola, which I mentioned earlier, 20 years ago, there was a very clear growth path for Coca-Cola. They could expand into different markets internationally, and it looked very likely they could just sell more Coke every year in more countries. Today, there's a different trend going on. In developed countries, people are drinking less soda. So the same growth driver isn't there. Now, Coca-Cola is still growing its dividend, but that growth rate is likely to be slower. So that's what you need to look for is, will the company be able to grow at the same pace as it has?
Yeah, and the rate of growth. I think that's important. It's not just being able to stick with a certain level. It's actually being able to build a business over time. Ben, we're nearing the end, but I want to touch on one more topic, which I know people love to discuss, which is this concept of dividend aristocrats. Give us the 30-second summary and what people should be looking for.
Absolutely. The dividend aristocrats are a group of 51 stocks in the S&P 500 that have paid increasing dividends for 25 plus consecutive years. So these tend to be the strongest companies around with the longest histories of dividend growth. They're what you'd call real blue chip stocks. And why should people care? Well, besides the dividend history being long, the Dividend Aristocrats Index has outperformed the S&P 500 by over 3 percentage points on average a year over the last decade. And they've done that with lower volatility than the S&P 500.
Certainly something people should be looking at. Another thing, Ben, I think people should be looking at is the Sure Dividend website. Just tell us in the last few seconds, how can people follow you and follow your work?
Absolutely. Just go to suredividend.com, and that's the Sure Dividend website. And you can see all our past articles on our archives page there. And we're going to have a special link to the Dividend Aristocrats list on the interview page for this interview as well.
That sounds great, Ben. We're going to put a link to that at the show notes of today's show at goldsteinongelt.com. Ben Reynolds, thanks again for taking the time.
Thanks for having me on. I appreciate it.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.